Morning everybody, welcome to the weekend general update for the 14th of July and we've just seen a very strong week. The S&P in America rose on every single session and closed the week at a new all-time high. So markets are very positive at the moment and we certainly saw some good positive action excuse me, in the Australian market, particularly on the last couple of days. Thursday and Friday were really strong days in the Australian market. So let's have a look at the action for the week, and we'll start with the S&P, and it ended up rising 50 points, which is a big week. That's close to 500 points on the Dow. So a huge week, and as I said, rose every session and either finished on or very close to the high. So that meant that the buyers were basically still coming in right at the end of the session. It was an all-time closing high, not an all-time high price that was formed a couple of weeks ago, but it was certainly the all-time closing high. And what's really encouraging about the US market, as I've been saying now for many months, is that the Russell 2000 index for small and mid-cap stocks has been outperforming the S&P index. And that's really positive when you've got that much breadth in the market. It just shows you how much strength is there. Now on the S&P, technically I would expect to see some resistance just a little bit above where the market closed on Friday night, around 1688. If that breaks, then I think you'll see a surge higher, and it's impossible to know at this stage where that might target, because it's new territory up there. But I would expect to see some sort of pause around the 1688 mark. So here's the S&P. This is the chart we've been looking at now for quite some time. We had a substantial and very smooth trend channel. We dropped out of that in a slightly bigger correction, an ABC correction. So this is the A leg to the downside, then the B, and then the C leg. That's now completed almost exactly at the 38.2% retracement level. And now has moved higher, and as you can see, that's the highest price that the market's ever closed at. So technically the index is performing right on cue. It's been very predictable, and I've hear and read a lot of commentators saying how difficult this year has been. I'm not quite sure what it is they're trading, because I think markets this year have been very predictable. And if you got yourself organised, then there's been some terrific profits available. Now let's have a look at the Russell 2000 index. So we'll just pan back and have a bigger look at the Russell, and you can see all-time highs, and it's still in quite a steep uptrend. Now both indices, if you look at the price in relation to the 150-day moving average, both of them are getting quite extended away from the mean. You can see the RSI here is getting up to overbought level, so expect to see a bit of a pause and a bit of a pullback shortly. I would expect in the next couple of weeks we should see some sort of minor correction to the downside, and given that the S&P is basically sitting, let's just go back and look at that S&P chart again. You can see here the all-time high is just up here at 1688, and the S&P closed at 1680, so another 8 points higher. We've got an all-time high. I would expect to see a little bit of resistance and a bit of a pause around that area. Now moving on to the Australian market, the ASX 200 rose 120 points on the week, gave back some of the gains late on Friday, but this has been the most consistent directional week for some time. If you wind back over the last few weeks, it was basically a yo-yo, day up, day down, just day after day after day. It was very confusing market action at the index level. But this has been the most consistent directional week we've had, and the good thing is that money flows are broadening into resources and mining services. It's not really that much at the expense of the other sectors like banks. The banks are still doing okay, but it's certainly the resources and mining service areas are seeing a lot more capital inflow now. And some of those opportunities are really mouthwatering, but just beware. Resource stocks are more volatile by nature. The sentiment around China is still pretty brittle, so it doesn't take much to upset sentiment around those particular sectors. So the non-resource sectors, I think, are still a very attractive area to be. You've got to be selective, but certainly there's opportunities building in those resource areas. So let's take a look at the Aussie market. So we'll start with the ASX 200, and you can see over these previous month or so we just had this basically big ranges flicking backwards and forwards, but we actually got some consistent direction in this last week. So that was certainly an improvement, but some selling pressure on Friday afternoon. If you look at the materials index, you can see had a much better week. Very good days on Thursday and Friday. And if we look similarly at energy, is the energy index also had, in fact, it's had a more like 8 or 9 days of a lot more strength. And just one other one I want to take a look at is the small ordinaries index. So this is the XSO, and you can see also been a strong rebound. There was a heavy sell-off in the small ordinaries index that started in March, but bottomed out about 10 or 12 days ago, and that's been quite a sharp rise. So good signs for the small caps. Now moving on to the commodities, gold had a big week, rose by $57, and Aussie gold stocks are on the rebound. Now we'll look at the GDX and GDXJ indices as well in America. They are okay, they're still in basing pattern, but certainly we saw some pretty enthusiastic rebounds on Thursday and Friday in Aussie gold stocks. So again, high risk, high reward, so take care there, but certainly some better signs. Now copper, in fact copper didn't slip, it rose to $3.14. The US dollar just fell back a little bit in the last few days, and oil jumped up again to $106. So that's been a meteoric rise in oil in just the last few weeks. There's the spot chart for copper. So you can see still doing quite well. And let's have a look at the gold chart. First of all, on a daily chart, so you can see we had 3 good days in a row on gold. A little bit of a pause over the last couple of days. But if we switch over to the weekly chart, it may not have bottomed yet. And that's why I'm still a little bit cautious on gold stocks. It was a nice rebound, but you would recall me saying for a long period of time that gold stocks will start to turn before the price of gold bottoms. So don't be surprised if we've seen the bottom in gold stocks, but we have just a bit more downside on gold yet, down to test this 1156 area. I think if we got down to 1156 and reversed, that would almost certainly be the low point for gold, I believe, and wouldn't be surprised to see gold stocks heading up prior to that. Let's look at the GDX. So you can see it really does seem to be basing. We've had a couple of good sessions, some very good volume spikes in there, so it's looking more like a base now. And if we look at the GDXJ, now there's been an adjustment here in that index, so just ignore that massive gap there, but you can see that the GDXJ is actually looking better than the main index. So these are the smaller gold producers in America and Canada. And the final one I want to take a look at is the Australian GDX market, which is XGD. Now this is essentially reflecting what Newcrest is doing, because that dominates the index in Australia. So this is really a bit of a mirror of Newcrest, but nevertheless you can see that's the most positive 2 days we've had in a long time, and we've now formed a new short-term high. So hopefully we've seen the worst of it for gold stocks, and we're into a turnaround period. So just to finalise, last week we had a continuation of the outstanding run that we've had for high quality small caps, and we're now getting the resource sector starting to join in as well. So it really has been a terrific period this year. And that's why I say I'm confused by the commentators that are saying what a tough year it's been, because from my perspective, it's been very predictable, and there's been some terrific profits to be had. Uh, these are the same comments that I made last week. They're still applicable, so I just want to remind you about those. Avoid large stocks that are going to be owned by overseas hedge funds. So we're talking the banks, BHP, those sort of stocks, because if the Aussie dollar falls, there'll be increased selling by overseas hedge funds just to avoid the currency loss. And that selling will be focused on the biggest stocks, because they're the stocks that have got the liquidity where these overseas hedge funds can get in and get out. So it doesn't matter whether the stocks are cheap, whether they're attractive or unattractive, it just doesn't matter. If the Aussie dollar keeps falling, then the selling will continue, and that's the long and the short of it. And and currencies to me are, I mean, who knows with currencies these days, because a single political decision can radically change the currency direction overnight. So I have no desire to try and predict currencies. I believe that there should be, over the medium term, the Aussie dollar should head lower, but what it does in the short term, I've got no idea. So I'd just rather stay out of those stocks that are perhaps sensitive to changes in currency, and stay with stocks that are standing outside that. And as I said, it's to me it's been a very predictable year, and I see that continuing in the second half. So that's it for this week. Cheers.